everyone, and welcome to the IndiNations 7 Generations Investing Podcast. I'm Jeremy Bryan, and this is powered by IndiWealth. Today, we're going to talk about the investment policy statement and really why this is such an important document to kind of build your financial priorities, your tribal priorities, or your foundation priorities into an investment discipline. I think this is the guiding approach. This is the centering document, if you will. It brings everything together of what you're trying to do with your assets to achieve your mission. The investment policy statement should absolutely be a part of that. And we're going to go through what makes a good one, what makes a bad one, and the things we would watch out for. So let's get started. So I call it the document that lasts. The IPS is something that is meant to sustain across the landscape. So it's meant to outlive the current council. It's meant to outlive a lot of things. It's not meant to outlive the mission, because that is what it's there for. But it is meant to outlive, potential transitions, adjustments to the mission, these kinds of things. It is meant to be a part of that conversation. But let's start with a quick scenario. So let's say a new council has just been seated. I know a lot of you are coming up to elections at this point right now, so this is entirely possible. Now, what we haven't experienced here recently, but absolutely can happen. Let's say we just get seated and now the stock market is down 15% in the last 2 months. The new council comes in and the first thing they says is, well, wow, this is awful. And, we have this money and now we're down 15% in the stuff that we're invested in. Why don't we go to all cash and just wait it out? And maybe that's the best approach. And really, there's no investment policy statement or IPS in place to guide these decisions. What happens is a lot of times the emotion can override the process. If you don't have an investment policy statement in place, a lot of times is emotional decision making overrides the process that you've set up to establish the mission. So that is what an investment policy statement is there for, is really to kind of bring it back to understanding what you're trying to do, what you're trying to accomplish, how you set up yourself for these scenarios where a new council has come in and the stock market is having difficult times. You can always be able to go back. A good investment policy statement allows you to go back and really kind of recenter yourself into what you're trying to do and the time horizon you've established to do it. So what is it and what it is not? The investment policy statement, I call it's just a working agreement. It's between the entity and its money. That's really what it is we have aligned this. We are a tribal nation. We're a native foundation. We have this money. Here's what we want to do it for. It defines the mission succinctly and right in the first page is what I used to like to say is, what is our purpose here? How the money is invested, who has responsibility and authority. We want to know both. Who is signing this document? Who's reviewing this document? What kind of things do we need to do to make sure we're fulfilling our duties? And then how do you measure progress? How is this paid attention to so that we are continually looking at it to make sure we're on the right track? That is what an investment policy statement sets up for. What it's not is a binding legal contract. So this is not something where you're going to sign it and say, this document will never change and this is tribal law at this point now. It is not like that, but it should be looked at, especially by an advisor, as the guiding force for how you're going to invest this money going forward and what this money is for, what the spending will be like, these kinds of things. So while it's not a binding legal contract, it really does establish that fiduciary standard or looking out for the mission's best interest over your own personal interest. That's what being a fiduciary means, and that's what this document helps along. It's not a marketing brochure. You're not putting this as part of our sales strategy. It can be a communication document. If it's written in clear language and it's written in a way that shows what you're trying to accomplish and how you're going to set it up, it can be used as a communication standpoint to your citizens or to your board members if you're on a foundation to expressing what you're trying to do with this money. It does not have to be salesy and jargony, though. This is not a marketing brochure. And lastly, it is not set in stone. This is meant to be flexible as the mission changes, as markets change. That will be actually less important, though. I always say that market changes usually don't change the investment policy statement much because you've delineated what you want from a growth perspective, a safety perspective, that kind of stuff. So it's not usually market changes that change this, but changes to the mission, adjustments to the people and the responsibilities that you've set forth. Those kinds of things should be flexible and adaptable over time so that the IPS remains a working document. So without a guide, without an IPS to guide decisions, kind of what tends to happen? What can we start to see? And a lot of the one that I talk about is drift, is that you start to drift away from the mission to a certain extent. Is this covering now a couple of things, and are we doing different stuff with the money that we were doing before? So there's mission drift, and then there's also investment drift. And asset allocation can get away from the stated intent, is that you're kind of, you're allowing growth to continue to grow without a rebalancing strategy, without an adjustment based upon time horizon, these kinds of things, where it just kind of drifts away from really what you've set forth in the document. And that could just be from lack of review, just inertia over time, not paying a ton of attention to it. These kinds of things can get away from you. And it usually is quietly over a period of years that this happens. It's not usually instantaneous. But that period of drift can be the IPS can be a guide to kind of allow yourself a little bit of flexibility, but also not get completely away from the asset allocation and the mission you've set forth. Crisis-led decision-making, I talked about that before, is that the decision-making framework, especially around emotion, tends to lean itself towards more buy high, sell low. Now, if you've listened and followed in the markets, what does everybody say? You should buy low, sell high, right? Well, in practice, that's a lot easier to say than it is to do, because when things are going well and the markets are growing phenomenally and everybody feels great because they're getting more and more money, it is difficult to have a discipline to saying, hey, maybe I want to take some off and rebalance this, because you want to feel like risk because things feel great and it feels like it's never going to end. And on the same side, the sell low comes from, again, emotional decision making, that when things are down 15, 20%, it's easy to say you'd be a buyer then, but it's usually down because things feel terrible. And you feel terrible for owning these things and that kind of stuff, which usually leads to selling at inopportune times. So again, the crisis-led decision-making can lead to emotional, which avoids the process. And that's what we want the IPS to do for us, is to provide that process and that guideline to let us know what we're trying to accomplish here and to avoid that emotional decision-making. The politics side, again, I believe councils should be allowed to formulate strategy. That's what you're elected for, right? Is you're elected by your citizens to do something. You have stated a platform, you stated things you want to accomplish, the things you want to do, should absolutely be allowed to formulate that strategy. What I would say is an IPS allows you to not have to start from scratch every time. When you have a new council member come into the fold, the IPS should be a governing document that says, okay, here's what we're generally doing from this perspective. And if we want to change this, here's the process for doing so. So the IPS can not only remain what we're doing now, but also the structure for what we want to do if there are changes to the council's philosophy or the board's philosophy on what the mission is going forward. So a strong IPS, again, continuity, I think, is a big one, is that, you have leadership changes. That the biggest change or the biggest constant in councils and foundations and tribal governments is that change is inevitable. It's going to happen. The IPS can provide some continuity during those changes that allow you to, again, not start from scratch every time. Discipline during times of stress. Again, I said, you've kind of set the guidelines, you set the asset allocation ranges, and we'll talk about that in a bit. But during times of market stress, that's when that's most important, because you're going to feel terrible, and again, things are going to be, difficult to do that buy low mentality. You're probably going to feel like you should be selling. But we get disciplined by having an IPS that allows for these ranges and that has been thought up beforehand. The homework has been done beforehand to understand and provide for these scenarios when we have market stress. Accountability for evaluating, the roles and responsibilities, who's delineated for what and who has to bring us something, whether that's a review document, whether that's a proposal for an adjustment and those kinds of things, whether it's a new investment, whoever and whatever it is, you have accountability for who's doing it and how you evaluate your progress going forward. Mission alignment, I really believe that, again, I think the IPS mission should be on page 1. You should know what its purpose. What is the purpose of, we have this money, we're trying to do this. What is this? And that should be clearly stated right at there. And again, that's not always set in stone. Sometimes that'll be adjusted as you go forward, but it should be understood, because that's how the investments will align with the mission, not the other way around. And I think lastly is that this is pretty important, is that you want to have documentation that supports that you've been doing your fiduciary duty. You are looking out for the interests of the tribe. You aren't looking out for your own personal interests. That's what being a fiduciary means. That is what is important when you put it in the investment policy statement about what you're trying to accomplish and how you're going to accomplish it, and you're reviewing that consistently. I think it really does support that fiduciary duty. So let's work on the nitty gritty here a little bit. Part 1 is the foundation of the IPS. Again, I've talked about this ad nauseum, but I'm going to review it again, is that the mission, what is this money for? What is it meant to accomplish? Should be on page 1, absolutely. The roles and responsibilities, who decides what needs to be done and when. Really kind of establishes who has signing authority for establishing the IPS in the first place, who has the authorization to change it over time. What is that process? And then secondarily, as you're going forward, who is responsible for providing certain information, whether that's performance reviews, whether that, again, is proposals from the council and the adjustments and how we're going to adjust this mission going forward. Those kinds of things should be absolutely established in the investment policy statement. The objectives, again, the mission is really the purpose. The objectives is kind of your return structure, but I always say the return structure isn't just a benchmark. The return should not be, we want to beat the S&P 500 by 2%, right? Sure, you can use the S&P 500 as a benchmark, but the objective should really be tied to the purpose of the mission. And so we want to achieve financial sovereignty. We have a miners trust. We want this to be here at 18. We want it to grow up until, stages of 3-4 years before distribution, to where then we'll be more conservative. These kinds of objectives allow you to then set benchmarks to saying, okay, well, how are we growing compared to what we've set forth? But really take a step back and saying, are the benchmarks that we're choosing really aligned with what the mission we're trying to accomplish? Because again, if your mission is preservation, right? That this is contingency planning for the next 0 to 2 months or 0 to 2 years, right? Well, the S&P 500 should not be a benchmark in that regard in any way, shape, or form, because it doesn't fit the mission at all. So those are the kinds of things that you have to understand when you're setting those objectives and those return structures, is does it fit with the mission that we're trying to accomplish? And I think time horizon is a huge helper there. In short, intermediate, and long, I always think that that's the way to kind of assess and build this. Whether you're going to a board as a foundation, or whether you're going to the council as a tribal executive or CFO, I think establishing this allows for clearer communication. Here's what we have in the short term. And in the short term, we're protecting assets. Here's what we have in the intermediate term. We have a little bit of a hybrid approach here. We have some income, some growth, but we also have some protection from downside. And then lastly, in long, this is our long-term assets. We're going to allow this to grow. It's going to bounce around a little bit more. We're going to have some times where we have some difficulties here, but over a longer period of time, by staying the course, this is how we're going to grow our assets over an extended period. By establishing that time horizon, you can then communicate this better about what your mission, how you're accomplishing it, how you get to those objectives, and who's doing what. So if you set this as your foundation of your IPS, you're really along the path of being able to consistently achieve those missions over time. So let's talk quickly about the mechanics, the asset allocation side, what we're investing in and how we're investing in it. I always say set ranges. This shouldn't be a target of, 33% in stocks and 15% in bonds and everything else in alternatives, right? It should be in a range because you want to have some flexibility to take advantage of opportunities down the road. Again, under buy low mentality. And then also some flexibility to take profits and maybe be a little bit more conservative when you want to do that sell high strategy. So again, allowing yourself a little flexibility to have opportunity and to also protect some of the funds when you think it's necessary, I think is absolutely essential. But there should be a structure within there. And going out of that structure should require some real specific explanation, or at least some characterization of why you're doing it, and a review process to approving that, because that's what it is there for. Rebalancing, calendarized, or, rebalancing is basically just getting you back into your kind of targeted ranges, if you will. And so this avoids that drift that I had talked about at the outset. Is by periodically rebalancing, you can avoid that drift over a longer period of time. You can get yourself back into where you've set that asset allocation structure. It also it naturally takes profits when times have been going good and things are getting high. If stock market has gone really high and you've gone above that asset allocation range, well, rebalancing will get you back in there and it'll take some profits. On the other side, if stocks have done poorly, rebalancing will actually invest more in those and maybe take advantage of an eventual rebound. So it can be a profit mechanism as well, but it's really much more about just getting yourself realigned in the proper fashion. I tend to be much more of an asset allocation drift rebalancing. Is that now with technology, it's very possible and actually quite easy to not just do this on a quarterly basis or do this on an annual basis or anything like that. You can absolutely have it as part of your discussion during those times, but really you can set those asset allocation ranges through software that say, hey, if we're out of there, we get an alert system that comes, and an advisor or whoever's executing your strategy can rebalance on an ad hoc basis right then and there. Investable universe is just simply what's allowed and what isn't from the market. Can we invest in stocks? Can we invest in individual stocks? Are we investing in bonds? Are we investing in alternatives here? How much liquidity? And I'll talk about that in a second. But those kinds of things should be addressed. Is what can we invest in here? What are you comfortable with? And what are you not comfortable with? And somebody who is an advisor can offer you the trade-offs and the benefits of having these kind of different investments so that you can create your investable universe out of there. Liquidity is cash needed, and how do you access it? Now, how much liquidity do we need? How much do we not need? And what is the process of accessing that liquidity when we need it? So from that regard, I think that that's important just to understand from the spending policy perspective that you're going to have. Hey, if we're taking out 5% per year, where do we get this from? And then how do we rebalance that? And also, especially if you're going to do illiquid investments like private equity, private credit, venture capital, hedge funds, these kinds of things, there are liquidity restrictions to those. So understanding what those restrictions are and where you'll access funds if you need them outside of those arrangements, let's say if you're not allowed to take advantage of liquidity there, where else can you get it from? So you should understand that as part of the process. And again, the benchmarks, as I said before, I think that's only part of the progress measurement. It's not the whole thing. Really should align those benchmarks to what you're trying to accomplish in the mission, the objectives, and the time horizon. The benchmark should fit all of those. So let's talk about the tribe or foundation specificity here. So this is where it's a little different, is that starting with a template in the investment policy statement is absolutely fine. Like there's nothing wrong with that. But there should be, by the end of the working document, by the time you're ready to sign and bring this to your council, bring this to your board, there should be some specificity to what you're trying to accomplish and who you are as a people or as a board or as a foundation. First is, I think the spending policy is absolutely essential. Is what is the mission? How much do we need to fulfill that mission? And can the assets support the spending policy that we're trying to put forth? I think that's absolutely specific to the mission, because some may not need it for 20 years plus, a minor's trust, right? Somebody comes in and is born and they won't have a distribution until maybe 18 or 21 or maybe even 25. So there's a very long time there. Some of these more endowment related strategies is, hey, we want to be able to support our people on a regular basis. Maybe that's 5% per year. What is that number? What's the right number for that? And can the assets that we invest in support that? I think it's absolutely essential. The investments can be aligned with your culture and mission. Some people call this, ESG, impact investing, whatever that may be. That's fine. Those are just names, though. In my opinion, those are just labels. In my opinion, it's much more, you can customize your portfolio to what you like and what you do not like. You just have to understand the risks and trade-offs of that. Is that you can align and say, we do not want to invest in this, this, and this. And you can exclude the things you don't want. You can also promote the things that you do want within your portfolio. This is absolutely possible. Any advisor or any investment person should be able to put this together for you that fits your culture and mission. But they should also be able to tell you, when you're restricting things, it does restrict opportunity sets going forward. So if you're comfortable with that, it may deviate from a benchmark then, right? If you're saying you don't want technology companies and you don't want artificial intelligence companies, well, you probably shouldn't benchmark yourself to the S&P 500 then, because, they're massively weighted towards technology companies. So that's just one example, but really, it's okay to fit your investments to your culture and your mission, but just understand the trade-offs of doing so. The sovereignty of whether you're a native foundation or whether you're a tribal government, sovereignty should be respected and not just accounted for. And saying, okay, we understand you're a sovereign nation and we can do these kinds of things, and maybe have a waiver of sovereign immunity or a limited waiver. It's absolutely, it's that should be table stakes, to be completely honest with you, but really should be much more in the conversation and saying, we respect you as a sovereign nation. We respect that you have different approaches and things that you need to do with your money. How can we help you best fit the solution going forward? Should absolutely be respected. And lastly is reviews. Discuss your progress against your goals, not just against the benchmark, not just, hey, we did, the S&P did 2%, we did 2.1, we feel great. Oh, we did 1.9, now we feel terrible. Like, that is not a really good review system. You should know how you're doing against a stated benchmark, but does that benchmark fit your goals? And does what you're investing in still fit your goals as well? That's what you need to be looking at on a review basis. Quick red flags here is, if you haven't opened it in 2 years, you probably want to take a look and see what you got there. I'm not sure our benchmarks fit our goals. I've talked about that ad nauseum. If you're just saying we want to beat the market, is that a fit? Or we want to be just better than cash, but we have 20 years time horizon. Well, that's not a fit either. So understand how your benchmarks fit your goals. I have no idea how and when we rebalance. That's probably, again, because whether it's periodic, I think that's suboptimal, but it's possible, but it's at least it's a process in there. Or whether that's, hey, we get out of range, we get ourselves back in range whenever that happens. I think that's the preferred strategy, but know what you're doing. Have a knowledge of how you are rebalancing to avoid that drift that can happen over years. The new council or the new board have never seen it. This is something that should, again, it's a working document. New council, new board members are going to come in with new ideas, and that's absolutely what they're there for. But the IPS should be their baseline assumption in saying, okay, I have new ideas. Is it incorporated in here? If not, what's the process to making adjustments, and how does the approval go from that period? We signed it, but we don't understand it. A lot of times, again, from the template perspective, it's just, hey, we need one to get this done. An advisor puts one together, throws it forward, and says, yes, trust me on this. I don't think that's an optimal process. Is you should understand what you have here from a working document perspective. You should understand the mission. You should understand your asset allocation guidelines. You should understand your review process. Do you need to know every single investment you own and how much percentage it is? Absolutely not. That's what an investment professional is there for. But you should know the process of making sure that your mission is still being achieved, or you're on the progress to achieving the mission that you stated. So how do we get started? I think that's a very valid way to talk about it is, hey, we don't have an IPS at all. Well, let's begin the process of drafting one as a working document going forward that fits your mission and your time horizon. If you can get that, you're probably going to get most of this right going forward. And then having a stated review process is absolutely essential in that component as well. And then the roles and responsibilities, just understanding who does what. So it doesn't need to be a 50-page document. In fact, I always think that that's probably overkill. But it does need to provide the baseline assumptions of what your guidelines are of what you're trying to do. Have an IPS already? Well, just take a look at it. Let's start by that. Does the IPS, still match the priorities of the mission? And are the investments still aligned with that? So are we within our asset allocation guidelines? Are our asset allocation guidelines even right? Are they there? Are they included? If you have a working document, I think dusting it off and just taking a look and does it fit what we're talking about here is a really valid way to kind of start that process. Even if you have one in place, there's some fine tuning that can maybe be done. Either way, whether you don't have one or whether you do have one, start the thought of a review schedule. The first review can be, okay, we need to establish an IPS. What is the things that are most important to us? That's a board and that's a council conversation about, we're going to start this process. Let's get together and have a discussion about what the most important things are, bring in somebody that can help us out with this. And then also establishing those roles and responsibilities. And again, ensuring in recurring consistency that we're going to do this on a review basis, that we're going to continually look at this. It doesn't have to be every day. It doesn't even have to be every quarter. It can be once every half year. The more robust look, I would say you want to look at it at least once per year, but it doesn't have to be a 2-day long event, right? It can be, are we still aligned? Are we doing what we're trying to do? And is anything changed? If all of that is yes, and nothing's changed, then that's your review. And then see you next year is absolutely fine as long as you're still on the right track. It's only when you feel that something isn't on the right track that you should have that discussion. So I hope this was helpful. This is part of our Treasury Playbook for tribal nations, which I will absolutely put in the description below. You can download a copy and take a look. It has this and other information for a tribal government to kind of get started in the process. But with that said, that's our episode for this week. Tune in next week where we'll have our next hot button topic. Until then, thank you very much. Take care of yourselves.